60% stocks, 40% bonds. This is what our grandparents taught us. It's been the gold standard for balanced investing for decades now. But I feel like that 40% bonds might not be the safe haven people think it is. The problem with the 60-40 portfolio, in our view, is that the US deficit is effectively inescapable. Washington's spending and deficits are not going anywhere anytime soon, and that's going to pressure the US dollar. And if you think about bonds, the typical 40% fixed income allocation in that portfolio, bonds are promises for fixed dollars in the future. So if those dollars are worth less and they're buying you less, that safe return feels like anything but safe. So as we think about the 60-40 portfolio, we're not saying it's going to go away, but we do think it bears consideration for what could be similar in flavor to that 40%, but bear a totally different set of risk and return prospects. So think about things like fixed income alternatives, private credit real estate. So think about private credit, which could earn higher yields than US Treasuries, investment grade bonds, or corporates without the direct exposure to the Fed-linked interest rates. You can think about real estate, which tends to be inflation protected. Crypto assets like Bitcoin, scarce digital assets that hold the promise of being hedges against that US currency debasement. So these are all things that could get you bond-like exposure in terms of the inflation protection, the store of value premise, without that direct exposure to US fiat debasement, which in our opinion seems inevitable. So if you zoom out, the traditional 40% bond allocation has historically been a safety net, but it could look a lot less safe in the future. And I think it's worth considering what could be alternatives to replace that in this portfolio.